What if I told you there's a simple investing strategy that removes emotion, reduces risk, and has historically helped everyday Americans build serious wealth over time, and you might already be using it without even knowing it? It's called dollar cost averaging, and today we're going to break it all the way down. We're talking real numbers, real examples, and a clear action plan you can start using immediately. Whether you're brand new to investing or just looking to sharpen your strategy, stay with us, because this one is worth your full attention. So, what exactly is dollar cost averaging, or DCA as it's commonly called? Here's the simple version. Instead of trying to figure out the perfect moment to dump a lump sum into the market, you invest a fixed amount of money at regular intervals, say $200 every single month, no matter what the market is doing. When prices are low, your $200 buys more shares. When prices are high, it buys fewer. Over time, this averages out your cost per share. Think about it this way. It's like filling up your gas tank every week, whether gas is $3 or $4 a gallon. You're buying consistently, not trying to game the pump. Here's what most people don't realize. Trying to time the market is one of the most expensive mistakes an investor can make. According to a study by J.P. Morgan Asset Management, if you had invested in the S&P 500 from 2003 to 2022, but missed just the 10 single best trading days over those 20 years, your returns would have been cut nearly in half. 10 days out of roughly 5,000. The problem is, nobody rings a bell at the top or the bottom. Our emotions, fear when markets crash, greed when they soar, push us to do exactly the wrong thing at the wrong time. Dollar cost averaging sidesteps all of that by keeping you consistently invested. Let's look at a concrete example to see DCA in action. Imagine you have $200 to invest in a fund. Option 1. You invest all $200 at once in January. Option 2. You invest $100 per month for 12 months. This chart shows how the share price fluctuates over the year and what happens to your average cost per share under each approach. In a volatile market, which is the normal market, dollar cost averaging tends to lower your average cost per share compared to a single lump sum purchase made at the wrong time. The data illustrates why consistency often beats a one-time bet. Let's put a real number on this. If you had invested just $300 per month into an S&P 500 index fund starting in January 2000, and you kept going through the dot-com crash, through the 2008 financial crisis, and through the COVID crash of 2020, by the end of 2023, based on historical index returns, your total contributions of roughly $86,400 would have grown to approximately $580,000. That's the power of staying consistent. Not picking the right stock. Not timing the bottom. Just showing up every single month with the same amount. That number is historically grounded. Past performance doesn't guarantee future results, but it illustrates what disciplined, long-term DCA can look like. Here's the big picture. This chart shows the long-term trajectory of the S&P 500 index. Yes, you can clearly see the major downturns, 2008, 2020, but zoom out, and the overall trend over decades has been upward. Historically, the S&P 500 has delivered an average annual return of approximately 10% before inflation. Now, that does not mean every year is a 10% gain. Some years are up 25%, some are down 30%. But the investor who stayed invested through all of it, using a strategy like DCA, has historically been rewarded over the long run. This is why time in the market tends to matter more than timing the market. Here's the good news. If you're contributing to a 401k through your employer, you are already doing dollar cost averaging. Every paycheck, a fixed amount goes in automatically. That's DCA by design. Beyond your 401k, you can apply the same strategy inside a Roth IRA. In 2024, you can contribute up to $7,000 per year if you're under 50, or $8,000 if you're 50 or older. You can also open a taxable brokerage account and automate monthly investments. As for what to buy, many financial educators point to broad market index funds and ETFs that track the S&P 500 as a starting point for consistent, long-term DCA. But always consider your own risk tolerance and consult a financial advisor for personalized guidance. Here's the thing that trips people up. They think a market downturn is a reason to stop investing. It's actually one of the most powerful moments for a DCA investor. When the market drops 20 or 30%, your fixed monthly investment is suddenly buying significantly more shares at a discount. Then when the market recovers, and based on every historical bear market in US history, it has recovered, those extra shares you picked up at the bottom multiply in value. Think of it like your favorite store having a massive sale. You wouldn't stop shopping just because prices dropped. A falling market is shares going on sale. DCA keeps you buying through the sale automatically. This chart shows the hypothetical growth of investing just $200 per month over 30 years at the S&P 500's historical average annual return of approximately 10%. Your total out-of-pocket contributions over 30 years would be $72,000. But thanks to compound interest, that's when your earnings generate their own earnings, the projected ending value reaches over $450,000. Notice how the growth curve accelerates in the later years. That's compounding doing its heaviest lifting. The longer you stay invested, the more dramatic the curve becomes. This is why starting early matters enormously. Every year you wait is a year of compounding you can never get back. Even with a solid strategy like DCA, there are some common mistakes that can undermine your results. The biggest one: stopping your contributions when the market drops. We just talked about why that's actually the worst time to stop. Second, using DCA to buy individual stocks concentrates your risk. Dollar cost averaging works best with diversified investments like broad market index funds or ETFs, not a single company's stock. Third, being inconsistent with your amounts defeats the purpose. Pick a number you can stick with every single month regardless of market conditions. And finally, as your income grows over time, revisit your contribution amount. Increasing by even $25 or $50 per month can make a dramatic difference over decades thanks to compounding. Here's a sobering number. According to Federal Reserve data, the median retirement savings for Americans aged 55 to 64, the people closest to retirement, is approximately $134,000. That sounds like a lot until you realize that financial planners commonly suggest you may need 10 to 12 times your annual salary saved by retirement. For someone earning the U.S. median household income of around $75,000, that's $750,000 to $900,000. The gap is real. And it's largely because millions of Americans either started too late, stopped investing during market downturns, or never started at all. Dollar cost averaging, applied consistently over decades, is one of the most practical tools available to close that gap. Here's exactly what you can do right now to put dollar cost averaging to work. Step 1. Decide which account makes sense for your situation. If your employer offers a 401k with a match, start there and at minimum contribute enough to get the full match. That's an instant 50 to 100% return on that portion. Then consider opening a Roth IRA for tax-free growth. Step 2. Choose a broadly diversified index fund. Look for low expense ratio funds that track the total US market or the S&P 500. Step 3. Automate it. Set up automatic contributions on the same date each month so you never have to think about it. Remove the emotion, remove the decision, and let the strategy do the work. This is for educational purposes only, and your specific situation may differ. Consider speaking with a qualified financial advisor. When you're using DCA, it's important to understand what you're investing in. This chart compares the historical average annual returns of several common asset classes over the past 20 years. U.S. stocks, represented by the S&P 500, have historically led the pack. Bonds provide stability but lower growth. Cash and savings accounts have lagged significantly behind inflation over many periods. International stocks offer diversification. The takeaway here isn't that one is always best. It's that a diversified, low-cost approach gives your DCA strategy the best foundation. Putting all your consistent contributions into a single asset class concentrates risk unnecessarily. Let's bring it all together. Dollar cost averaging is not a get-rich-quick scheme, and you should be skeptical of anything that claims to be. It's a disciplined, proven approach to long-term wealth building that works precisely because it removes emotion and keeps you invested through both good times and bad. The data is clear. Time in the market, not timing the market, is what drives long-term results. Start where you are. Invest what you can. Automate it so you never have to think about it. Increase your contributions as your income grows. And remember, Every market dip is just shares going on sale. All investments carry risk, and past performance doesn't guarantee future results. But consistency and patience have historically been among the most powerful tools available to the everyday American investor. Everything you've seen in this video is for educational purposes only and does not constitute financial advice. All investments carry risk, including the possible loss of principal. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions.